Hi friends, welcome once again with a new topic, that is market anomalies. Friends, we have seen in our previous videos about efficient market, and let me just recall that efficient market, we have seen that is a situation when there is no possibility for any investor to make anything extra or can beat the market, because it is believed that the prices are simply random, and there cannot be any such situation that any investor has got some kind of advantage by doing some kind of analysis or getting some information prior. So in fact, the prices gets rapidly adjusted with any kind of information, and therefore price reflects all the available information at a point of time. This we have seen already in our previous lectures. Today we are going to discuss about market anomalies. In fact, market anomalies contrasts the efficient market hypothesis or efficient market theory. Market anomalies are all those factors or all those situations and circumstances which actually makes it very difficult to accept the efficient market theory. That means whatever the theory has purported, it is actually difficult in some situations to accept, or which discards the efficient market theory. So in anomalies we are going to see there are certain things in the market which in fact rules out, or in fact discards the efficient market theory. So we cannot believe the efficient market theory if there are anomalies or if there are some situations in the market. Let us check them one by one. So just to tell you again that market anomalies are the facts that happens in the market and from which we can declare that the market efficiency doesn't hold true. Market cannot be considered to be efficient, right? Or which contradicts the efficient market theory, right? Now let's go on and discuss the market anomalies one by one. The first anomaly that we will discuss is the calendar effect. Let me just explain you this in a very informal manner. We have seen that actually what we are discussing is from a behavioral dimension. Here we are talking mostly, when we are talking about calendar effect, we are talking about the investor's behavior in fact. So in a calendar, we are first talking about the day of a week effect. Day of a week effect. What does this mean? This means that our moods are not the same on all the days of a week. Okay? Sometimes we are with lot of positivism, we are very enthusiastic in some of the days of the week, whereas in some we are very pessimistic and we lack motivation and confidence. So the same thing is being researched, and it has been found that generally the investors, they lack motivation or they are pessimistic and on Mondays, right? On Mondays there are a lot of pessimism in investors, and therefore the stock prices on Mondays are generally lower than the average price of the entire week. So in other words, what I want to say is that Mondays can be accounted for a day in a week where the stock prices are generally lower as compared to other days in the week, because there is a kind of negative moods associated with investors on the first day of the week. Quite natural, because when we are on the first day of the week, we are into a lot of responsibilities. We are working in office as investors. We are actually giving our time in our investment decisions. So generally we have a lot of thoughts about our responsibilities for the entire week. But as we proceed towards the other days, slowly our mood revives, and we develop some kind of motivation and we energize ourselves, and slowly this behavior is reflected in the stock price, and as we enter the weekend, the stock prices show a rise. This is out of the research. Okay, so that means there is a weekend effect. So day of a week effect generally refers to the Monday effect. Okay, so generally the stock prices on Mondays are generally very low as compared to the average prices of the entire week as researched, and there is a weekend effect where we have seen through our evidences that during the weekends, generally the Fridays, we have mood revival, we have more of motivation, and that's why the stock prices reach higher, right? There is another thing that is here, that is the holiday effect. That means it has been seen that whenever there is a holiday before any trading day, or sorry, after the trading day, suppose today is the last trading day before a holiday, so tomorrow is a holiday, so today there will again be a rise in the price because people or investors, they have this mood of enjoying the holiday with family, and that vibe has been carried out in the market by way of more enthusiasm, and the price generally takes a rise on the holidays, right? So we have seen day of a week effect, we have seen the weekend effect, we have seen the holiday effect, and the next is the turn of the month effect. Turn of the month effect. So friends, these terminologies may be different in different literature. These terminologies are used, I mean there could be some other terms which represents the same thing what I am describing here. So more or less the contents will be same. So turn of the month effect. So this generally refers to the 28, 29, 30th of a month and the first, second, third of the month. So generally this is the month, and this is the end of a month, and this is the beginning of a month. So you will see during the end of the month people's have positivism. Why again? Because of course there are many people who get money in the way of salary at the end of the month. So, and they not just money, there is also a belief that something new is coming, a new month, a new hope, a new beginning, which again gets reflected in their behavior, and they generally trade actively during the end, and this mood remains for some period of time in the beginning of the month. Okay, so that's why if you compare the moods on the mid of a month with that of the end of a month, definitely end of the month will show you positive results. So this is known as turn of the month effect, right? Next comes the January effect. Again, people's mood and people's investors' behaviors is seen to be very positive by the end of a year and the beginning of a new year. So as you can understand, January means new year, new resolution, new belief, new thoughts, new imagination, and therefore there is a positive attitude in the minds of the investors, and that gets exactly reflected in the stock price. So friends, this is about calendar effect, and this effect why we are discussing, because if this is true, if this, as the research has evidence that this is true, if this is true, then how can we say that the market is efficient and people cannot make extra profit? Because if I know that we are approaching weekend, and what happens in the weekend, I told you the price will rise, so I can make profit. If I know that January is coming and in January the prices will tend to rise, I will buy more shares before that. So that's why that we say that this phenomenon, if it exists, then it is difficult to accept the efficient market theory, right? And that's why we are discussing under anomalies. So friends, we have discussed the first anomaly, that is the calendar effect. Now let's see the second anomaly. Now we will talk about the second anomaly, that is the momentum and reversal effect. Let's understand the momentum effect, right? This is actually possible for 6 to 12 months by observing 6 to 12 months stock returns. Okay, what does this mean? This means that you observe for the last 6 months or for the last 1 year, which are the stocks which are giving positive rise in price, or we can say winners. Which are those who are the winners? Winners means the ones which is showing price rise for the last 6 to 12 months, and which are those who are losers. Okay, that means the ones which is showing decline over the past 6 to 12 months on an average, right? Now how it will help you? This will help you because there is something called momentum. Okay, so the speed at which your price is rising, and suppose you give a stop here, this speed will take you for some more time. That means the momentum will be maintained for some more time. Similarly, if the stock price is falling and suppose there is a stop there, this trend will follow for some more time. This is called momentum. Just imagine that you are driving a car and you have taken a speed. There is a speed at which you are driving a car, and if you, after a certain point of time, if you just leave it, okay, of course your steering is in your hand, you will find that the car takes some time to get back to a to become stationary, or it will lose its speed gradually, because the speed that at which you are driving your car, it will continue to do so for some more period of time, because that momentum still remains. Maybe you have not done anything internally inside the car, but this momentum remains with the car. You don't have to accelerate, you just have to leave the car and you will see the car goes on automatically for some period of time, because that momentum is maintained. Similar is the case here. When you are talking about a price, a stock which has shown a rise in the price, it will continue to do so for some more period of time, and if it is falling, then for the last 6 months it has fallen, then it will continue to do so after a point of time also. Why it is? This may be because of investors underreaction. For example, why underreaction? Let me explain. This happens maybe because of investors underreaction. For example, if the price is rising, okay? Now, there could be reasons why the price should fall, but investors are ignoring these reasons, and that's why investors are taking time to understand and to, in other words, cognize those information, and for some period of time this momentum is maintained. Right? So it takes time for investors to react to new information, and by the time that momentum is maintained, and this gets the investors who is actually giving lesser reaction or under reaction to the information initially, that gets corrected over a period of time, and then only it will fall. Similar is the case when the price is falling. There could be some good thing for which the price should rise, but investors are imposing under reaction. The reaction is not very instantaneous, and that's why this momentum will be maintained, and then only the investors will give attention and it will get reflected in the price. So friends, this is about momentum. So how can it help an investors to make extra profit? If you can study the 6 to 12 month stocks, which are winners and which are losers, then you can understand that this momentum will be maintained for another short period of time. Remember, this momentum effect works for a short period, right? Because when you are leaving the car, it will run for a short period. After that, it will stop with a lot of jerks if you don't control it. So that's why this momentum effect is actually possible in a short run, because this momentum which you have observed over 6 to 12 months, that these are the winner and these are the losers, then you can make some profitable strategy that without taking any extra risk, that you will buy some winning stock or you will sell the losing stocks. Okay, the winning stock you can buy and losing stocks you can sell off, because you know the winners will rise further and losers will lose further. Okay, that's about momentum effect. Now let's speak about the reversal effect. Now reversal effect, for this will be possibly for observations for 3 to 5 years. Okay, study the prices of 3 to 5 years and then again find out which are those winner stocks and which are those loser stocks. Okay. Now friends, why we are doing so? We are doing so because it's believed that those who are winning will now become the loser and the loser will become the winner now, because this is a reversal effect, right? So the winners, the past winners will become the losers now, and the losers will become the winners now, because this is just a reversal. Right? And that's why it is said that the losers bounce back. In such situation, the losing stocks will bounce back and the winners fades away. That means the winners will fade, right? So why this happens? Again, there is underreaction and overreaction. So because the investors had been so underreacted that they have taken the price of the shares so high, and by now they are automatically adjusting, and now they are adjusting with the information, and now those who are winner for a long period of time, they now become the loser, because the investors took a lot of time to adjust themselves or react to the price, and that's why it had continued to rise and now it will fall. And the opposite is for the losers. The losers who were falling and investors were so underreacted, now that they will react and it will take the price high. And that's why in a reversal effect, the winners will of course fade away and the losers will bounce back. This is the reversal effect. Right, friends? So how can this be a profitable strategy? Again, you find out those who are winners for a long period of time, 3 to 5 years, a long time horizon. See, it is subjective. In some literature, this duration could be different. But however, we refer to a longer time duration, make an observation of those which are winning stocks and those who are losing stocks. And now you realize those who are winners, they are going to lose, and these are the losers, they are going to bounce back. Right? So this is the momentum and reversal effect. Now let's move on to the next anomaly. Now friends, let us study the size effect. Now when I say size, so there are large cap companies and there are small cap companies. So research has evidenced that there is possibility of making abnormal returns if you are investing in small caps as compared to large caps firms. Why? This is because there are many reasons, but research has evidenced the small caps firms produce abnormal returns, and if you want to make abnormal returns, you find out which are those firms which are smaller in terms of capitalization and put money on them, and you will find that your investment has brought about abnormal returns. Now the reason could be many, but I'll just give you one example, because small caps have a higher growth potential. They have higher growth potential because they are small and there are chances for expansion, okay? Higher growth potential, right? So since they are small, so they have the potentialities to grow further. But if there is a large company, to make it more larger, there is a time, there are lesser possibility. But in a small cap firm, there are chances for more potentialities of growth. Also, you can imagine that if I have a capital base of say 200 crores and this is a small cap, and if I have to yield, suppose this is giving me a return of say 9%. So if I want to produce a return of 10%, I will increase the size of the capital proportionately. That means for 1% extra growth, I would infuse some capital in a proportional manner. That means how much is required for 1% extra. But imagine the large companies, if it is having say 2000 crores, and if it is suppose it is producing 9% here also, if it has to grow to 10%, for extra 1%, the economic implication is very huge. It's quite large. For 200 crores 10% is less, but for 2000 crores 10% is quite high. So that's why to achieve targets for small cap firms is very easy as compared to large caps. And of course there is growth potentialities, and research is evidenced. Of course the biggest rescue in our case to defend this is that research has evidenced well that small cap firms gives more abnormal returns. So how can this be taken as an anomaly? Because efficient market says that there is no way you can make abnormal returns or abnormal profit. You can make, if you know which are if you profitably invest your money more with the small caps, of course the risk is high, but even then the abnormal returns will come to you, right? Let's move on to the next, and we call it the value effect. Now value effect. So actually we are comparing two things, that is the market value and the book value, right? Friends, I have been repeating this many times that there could be some difference between the market value and the book value. Market value is the price at which the security is traded, and book value is its intrinsic value. Okay, the worth of the security or the benefits that it offers to the shareholders in the true sense. Now, Eugene Fema has made study, and likewise there are other researchers who found that those shares which have a lower market value as compared to the book value, and we call them underpriced shares. Underpriced shares. These shares are likely to give you abnormal returns. They will give you abnormal returns, right? So if your market value is less than the book value, then you will find that the shares are underpriced. Of course, they are underpriced because market value is reflecting lesser than its true worth. Then you will find out that these type of stocks are giving you abnormal returns. Okay, but the same is not true if you make it opposite. That is, if book value is greater than market value, that means the shares are overpriced and therefore there cannot be abnormal returns. So friends, how can we make it as a points to discard the efficient market theory? Efficient market theory again says that the stocks or securities are correctly priced, and there cannot be any such situation when there will be imbalance or one is different than the other. So that means we are discarding this efficient market hypothesis, where it has been evidenced through research that when the market value is less than the book value, we call it low market to book ratio. Low market to book. Okay. So if the ratio of market to book value is lesser, then I can say that the securities are underpriced, and consequently there are chances of making more abnormal returns. So friends, this is the value effect. Let's move on to the next and the last for today's discussion, that is the post earnings announcement drift. So let us understand the last one for today's discussion, that is post earnings announcement drift. This is propounded by Ray J. Ball and Brown, 1968. Now, what does this say? This says that there is something called earning surprise. Earning surprise. What is earning surprise? When your expected earnings is more or less than what is if your actual earning is deviating from your expected earnings. It can deviate positively, it can deviate negatively, right? So it could be a negative surprise or a positive surprise. Now whatever it is, if it is a negative surprise, the price should adjust instantly and go down. If it is a positive surprise, the market should adjust the price rapidly and the price should go high. This is what the efficient market hypothesis expects. But this is not what happens in reality. In reality, it has been believed that, suppose this is the day of announcement, so day 0, and 1, 2, 3, 4, 5, 6, 7, 8, likewise we have many number of days, day 1, day 2, day 3, day 4, day 5, day 6, I'll go till 60. Okay. Now on the day when this announcement has been made about a particular event, then what happens is that the stock jumps up immediately, and this takes a lot of time that the price will reflect all the available information, and it says that it takes almost 60 days time. It takes almost 60 days time for the price to adjust with the information. That means the price should immediately adjust with the earning surprise. If there is an earning surprise, the price should immediately adjust, but this is not what exactly happens in reality. It takes time. So in my case, you can see the price has gone up to this limit, and it took almost 60 days time to adjust. Similarly, if it is a negative news also, it will jump, but then gradually it will drift, and it will take almost 60 days to adjust with the negative news. Right? So friends, how can it help the investors? Yes, it can help the investors to make abnormal profit during this duration till it reaches the 60 days. If I know that any announcement, it drifts up to 60 days to get fully adjusted, I can make this opportunity I can take opportunity to make abnormal returns, and I can take this advantage. Right friends? So this is about the post earnings announcement drift. Hope these explanations would stand useful for you, and with that I conclude today's video, and we will meet again in the next day in the next new video. Till then, take care. Bye bye.